The big question in the real estate market is now a good time to buy or to wait? And there are a lot of different opinions on this, and we're going to go over some big difference opinions from multi-millionaires, even a billionaire. But before we get into that, I think it's important to weigh out the facts. I'm Matthew Pohl, host of the Market Pulse podcast, and we're going to jump right in and get you guys the facts that you're looking for.
Monday, Tesla CEO Elon Musk said home values and residential real estate will follow the meltdown commercial real estate is experiencing right now. Whom should you believe? Well, if anybody should throw in their 2 cents or 2 billion cents into this argument, it's the queen of real estate, Barbara Corcoran. She joins me now in a First on Fox Business interview here in studio. Barbara, great to have you.
Pleasure to be here.
Well, whose side do you come down on?
Oh,
this?
Definitely. There's no relationship between the commercial and the residential. And the residential is starting to rebound, I agree. But the commercial is in trouble, yeah.
Okay, so Elon's wrong.
Of course he's wrong yet again, but he's cocky. And sometimes that counts for more.
Yeah.
All right, so we clearly got weigh-in from Barbara Corcoran and Elon Musk. So who's right, who's wrong in this battle? Well, I think Barbara Corcoran definitely has a cognitive bias because she has a ton of money in the real estate, particularly residential real estate sector. And so naturally she's going to want to maintain or at least have that continue to grow, where Elon Musk doesn't really have a pick in that fight or that battle, you could say. But I think some of the data that I'm going to show you here in a second is quite revealing to Elon's point. What we're looking at here is the national year-over-year growth in investor purchases. Now, this is investors going into the market and buying residential real estate. And you can see on the far right over here on this side, we are at a 49% decline in investor purchases. Now, what does that mean? It means that the appetite for investors has significantly dropped year over year from even last year. Now, why is that happening? Well, it has a lot to do with the return on investment. Right now, you can go out to a bank and at a CD get a 5% return, where in your real estate investments, you are getting maybe a 4.5% cap rate. With interest rates now going up and in some metropolitan areas, residential properties dropping in price, it makes it even harder to get the rent rolls that you need to have a profitable property. So I think Elon might be right according to this data. Now, Barbara also makes the argument that there's no correlation between the commercial real estate market and the residential real estate market. And I don't know how that's possible. We know, and it's kind of general consensus at this point, that the commercial real estate market is being highly impacted by interest rates and banks' ability to continue to lend or refinance at a good rate, right? Interest rates have gone up. Therefore, when a commercial real estate has to refinance, it's going to cost them more to have that property. Now, having said that, the banks are the ones who give the loans to commercial real estate. The banks are the ones who give the loans for residential. And right now there is a squeeze on banks. We've already seen that with multiple bank failures, and there's been multiple predictions of future bank failures because of the commercial real estate sector. So what does that mean for residential? There's no impact? I would say that there is a direct tie, and the tie is the banks. Are banks going to, one, be lending at low rates? No, they can't. Interest rates have gone up, so the same thing that's affecting commercial real estate could potentially affect residential real estate. Two, is the appetite for banks to give residential loans as high as it used to be? Absolutely not. Because of the pressure, especially these regional banks that have a huge amount of their portfolio in what's called CREs, or these commercial real estate funds, these sectors of commercial real estate, because a ton of their money is locked up in that, they are trying to hold as much as they can in reserves so that they can protect themselves from what's been happening to some of the failing banks, and that's a run on the bank. So if all these banks, specifically regional banks, are holding and being really tight and stingy with their money, isn't that going to affect in some way, in some fashion, also residential lending? I would tend to lean on yes, that they are correlated. Barbara may be right that commercial and residential can kind of go up and down separate from each other, but there is a correlation to how both do. And at this point, it's really the banks. They're both tied to lending, access to fund from banks, and what's the appetite that banks want to lend out right now. Now, to take the opposing viewpoint, or Barbara's view, there is a lot of data that has come in recently that makes a strong argument that U.S. housing prices are going to and have been continuing to go up. So if you look at this chart, and this is real-time data that we provide our subscribers on the Market Pulse podcast. So if you're not already subscribed to this channel, make sure you hit like and subscribe, because we do this every month, and this data comes in hot, faster, sometimes 2 to 3 weeks sooner than the news reports on it. But look at this data right here, guys, right below. This last month, the month of May, we had higher average listing prices than we've ever had nationally. And so does that signal that the housing market is recovering? I would say it's signaled that the housing market has recovered. You can see this lull that kind of came down into the bottom here. This was 2022. But over the last 1, 2, 3, 4, 5 months, guys, we have been in a steady increase in average listing prices. So does that mean that the future is going to be this steady incline? Not necessarily. There are some variables that are playing into this, and it's the one that the feds are trying to control the most, and that's the unemployment rate. So you can clearly see on this chart, the data is showing that we are at historic lows in terms of unemployment. Yes, you can see the spike, just below here, that was caused from COVID, and then we got everything stabilized. The feds might call this a soft landing, so to speak, in terms of where unemployment is currently, but we're still back at like all-time records in terms of like very, very low unemployment. Yes, last week we did have a slight tick up, and you can see that data like right here at the end of the chart, but it hasn't been significant enough to impact the market. So what does it mean for you as a potential buyer or seller in the real estate market if unemployment is intentionally, the feds are intentionally trying to get it to come up? Well, as unemployment creeps up, homeowners will be eventually forced to sell. And when you're forced to sell in a market and then rebuy or get into something new, investors, as we talked about, aren't interested at the current price. Why? Because with the current rate, they can't get a rent to be profitable. So homeowners will be forced to bring those prices down to meet and match rents. And Phoenix is actually one example of that, where it's happening everywhere.